Hello. On a 1 minute chart, after the price starts its run, again, here's that sell side delivery, or sell side liquidity rather, I'm sorry. Getting a little animated here. I don't need coffee, brother. Chemical imbalances do it for me. Sell side liquidity, relative equal lows, and the silver bullet here. So we're going to anticipate price drawing initial to this one, and over here. Here we accelerate to dig into this sell side liquidity pool there. So we create a sell side imbalance, buy side inefficiency, a SIBI. Remember, if it's a fair value gap, if it's a down closed candle, that means it's a SIBI. That means we anticipate price at a later time, at some time, it's going to reach back up into it with the expectation that it should offer new opportunities to do what? Accumulate new shorts. If we're bearish, would we want to see this entire range completely repriced too on the upside of it? In other words, overlapped with movement up? No, we don't want to see that. Why? Because if it starts keeping these things open, remember I was teaching you about the 5 minute fair value gap here where it was left open. I would want to see that stay open on above this high here, not completely overlap that candle. The same idea there is what we would expect here. We want to see the upper portion of an inefficiency stay open. So every single time an inefficiency manifests itself in price, if I'm bearish, I am actively interested in seeing if it stays open. The upper half of it needs to stay open. As long as it's doing that, that gives it lots of room to keep going down. Why? Because it becomes a measuring gap. Breakaway gaps, measuring gaps, and then you can have exhaustion gaps. So this inefficiency, we would want to see the upper half of that stay open. Why? Well, several factors. Number one, it would invite the likelihood of continuation going lower, which we haven't even traded to the sell side here, which is that red level. So the stops or sell stops below that red level haven't even been engaged yet when this was formed there. We have an old low here. So the likelihood of it going up and completely overlapping this one down closed candle and still going lower, I don't like that. So if I was in a trade and I saw this going up to that point there, it would be extremely critical for it to immediately and aggressively reject that and go a lot harder lower. If it was meandering around and not willing to go aggressively lower after going into the high end of this level here, then I would kill the trade. I would collapse it and just be done, because to hold on to a trade like that in an area where I know the likelihood or probabilities would be shifted against me, then I'm going to start spending mental capital. Even if I have open profits in the trade that have not been realized yet, haven't closed the trade, I'm going to start spending mental capital, meaning I'm going to be worrying and stressing about something that I don't ultimately have any control over. And then I'll start wrestling with the idea, if I get out, it might move in my favor and I'll regret that. If I stay in, it's going to eat up more of my profits. So as soon as you start getting to that point in your trade, are you in control of your trade anymore? No. So you just abandon it, abort it, take your profit, whatever it is, and move to the next opportunity. If it goes against you and would have stopped you out, wonderful, you did the right thing. If it moves in your favor and goes to your target, wonderful. That means your model was correct and you managed yourself correctly. You have to manage you. Nobody's going to do it for you. I'm not going to be in the room tapping you on the shoulder. Hey, you know you shouldn't do that. You have to develop these skill sets on your own. So if it's not going to go in the upper portion of this gap and trade higher and close it in or reprice to it, we want to see the halfway point or less be sensitive. And here's 25% of this SIBI. I'll show you what that means. From this candle's low to this candle's high, 50% level there, and then lower quadrant or quarter of this range. You can see it here. 0.25 is the measurement from this candle's low to that candle's high. So if I'm bearish, I want to see the market respond aggressively and sell off at either the quarter or the halfway point and not trade up into here. Okay? Because the algorithm, if it does these things like that, that's like a warning sign for smart money to just be careful, don't add new positions. That's what it is, folks. I mean, it sounds like conspiracy theory, sounds like contrived Tom Clancy kind of shit, but that's just the way it is. Okay, it is the way it is. And you tell me, what's the price level here on this high, on that candle? You're going to be looking at it up here, okay? This upper left-hand corner. What's the high of that candle right there? 15,652.75. What's the quarter level? 15,652.75. Find that in your fucking supply and demand, okay? Find that in Wyckoff. So the market goes up into that range. We want to see it stay open. If it closes, then you have to deal with it differently. But every inefficiency, I'm trying to anticipate them staying open. If I'm bearish, I want to see the upper half stay open. If I'm bullish, I want to see the lower half stay open. They may come back down and reprice. If it comes down and reprices, and it hasn't, like for instance, if it hasn't gone below the sell side here, this is important stuff. These are the things that you need to be listening to and why these fucking live streams and videos are beneficial to you. This is the stuff you don't want to hear and see other people complaining, but this is the stuff that's going to make you fucking money. This is going to be the thing that helps you keep your money. If this would have repriced to the upper end of that candle's low, if it would have done that, and it did not go below this red level, which is the sell side liquidity pool on the 5-minute chart, that means that I would still be willing to hold the trade, but it needs to start dropping aggressively once it gets there. It cannot wait around and spend time like it was doing here, consolidating, and then goes to the lower quadrant of that sell side and balance buy side efficiency, then dropping. I don't want to see that once it does this, goes back up again. If it would have done that, I would have held the trade. If it would have done that, but it would have been a time stop added to it. That means as soon as it touched this candle's low, it's got 2 fucking minutes to get in my favor and outside of that range here. If it doesn't do it, I'm taking half the trade off or all of it. Because the likelihood is they may not come back down here to take that sell side until New York. Big paradigm shift, what I just gave you there. For the new folks, it's going to feel like it was mumbo jumbo and means nothing. And it's because you're still too new to know what's good information. But that stuff is algorithmic. That is real mechanics behind how you manage a trade, how you manage risk, how do you anticipate and forecast future price delivery, and how you manage yourself psychologically, emotionally. All these things are predetermined protocols. I know exactly what I'm doing, how I'm going to do it, how I'm going to behave. I'm not surprised by price action. I'm not worried about missing a move. None of those things, because this is how I internalize price. These are the benefits of reading and learning what it is I'm teaching you. But you can't just watch this video, this live stream with me live, right here in front of everybody live. You can't just watch this one time and walk away with, yeah, I know exactly what he's talking about. You have to go into your charts and build a library of these examples in specific times. So anyway, if we're anticipating that price run from up here down into, we'll just use the easiest one, which is the sell side liquidity pool here. So from premium to discount, we have a inefficiency here. If we were framing that red line to the mean threshold of the 15-minute bearish order block, if that was the context we were framing for premium to discount, could we take a short in here or add to it? Trick question. I'll give you a second while I get a drink real quick. If we take the fib, and for the folks that have been with me for a while, you already know this, my students. Okay, here's the halfway point or equilibrium between that premium to discount range. High, the target, which is this, what kind of range is this? It's an implied dealing range. That means it's not been delivered yet. Up from here, we anticipate and we're expecting price to draw to this level here and lower. So that is a implied dealing range. When the market starts booking price and we get this big run here, does this drop or inefficiency, sell side and balance buy side inefficiency, does that occur above or below equilibrium of that implied dealing range? Meaning, is it above or below the 50% level? it's below. So while we are willing to observe and anticipate price being sensitive at the 25% to 50% level, we can't take a new position. We can't add to a pyramid position. We can't do that here. This is just an observation level to make sure everything is calibrated in our favor still, and we're just going to ride the trade out. If this inefficiency would have been at or above halfway point, that's where I do my pyramiding. Once we get below the halfway point, the probability shift in the manner that I am not willing to assume the risk, because if I start building more positions down here, we've already touched the level, and it could come back to that later on, and it could have a deep retracement. And we also have levels like the new day opening gap low that I would have all that new position sitting in drawdown, which would erode into open existing unrealized profits. So when I'm pyramiding, there's a context and a protocol in which I have to adhere to. And if I'm trading within a preconceived idea that we're going lower, I'm not just randomly picking something. I know what range I'm in. And this range is the range that we would use initially. If we are creating inefficiencies in here, or order blocks, something like that, I won't use that as a new entry for adding to the existing short position. It has to be in the upper half. It has to be in the premium, which is why I taught that in my core content.